Welcome to the school where we talk about the design of business and the business of design. I am Jose Caballer and this is Cristo. Today we are going to be talking about alternative compensation, whether it be equity, whether it be barter, whether it be something other than cash.
Right. We're going to pick up, because there was some interest online, and this is where we need to hear from you guys. If you have a follow-up question for us, and put it in there. We do read it. Jose and I were very active in the social space. Put it up there. We'll read it, and we'll respond in this fashion, right?
Yeah.
So I think we left off last time in a kind of really great place, right?
I'm pointing at the subscribe button just for a second. Don't forget to subscribe, and now we're continuing the conversation. There we go.
Anyway, so I have personal stories to share, and I want to talk to you about your
experiences.
Yeah. So let's
so this is a new topic, and the people that asked are curious because they're wondering, wait, should I do this? So the people that are
what is this? Why don't we start there?
Let's talk about what it is.
What is it?
So getting paid, for an example, with some cash, but then also a cut, an equity cut, that you are part owner of the company you're working for.
That's one way to do it.
Yeah.
Another way to do it might be a smaller fee up front and a percentage of sales. That could be a fee. That could be a way.
That could be a total way.
I love that model.
It's a good model.
You're incentivized.
So it's a revenue share.
It's a revenue share.
What other ways? There's other ways in the lieu of revenue share that have different. For an example, performance-based payment. So we're going to pay you a base salary, a base payment. Let's say if you're an agency or if you're a freelancer, and then based on quarterly performance of sales, you're going to get a bonus percentage of that because your contribution as a designer to the thing.
Another one, I mean, you can take it way back to the beginning of social interaction in terms of just bartering. I would do this for that, so cash is even exchange hands.
How have you bartered? I have bartered for everything.
I bartered
for legal services, for financial services, for like...
I bartered for vacation trips.
What?
Yeah.
How do you do that?
That's pretty good, man.
Damn. I bartered for product, for the client to give us product. I tried to barter for some cars one time. That didn't work out.
Didn't work out. They never want to give you a car.
They never want to give you a product at that scale. Yeah.
It's too big.
Too big.
Yeah.
But you can do that. So let's talk about equity specifically because I'm in the process now in a lot of the startups that we're advising, that Blind Labs is advising, I'm personally advising. I'm personally taking equity in the startups and the title of Chief Design Officer or something fancy like that, or Creative Director. Keeping in mind that I'm not there full-time per se, but I'm actually really making a very important contribution to not only the design, but also the process in which the startup is being built. So that's an interesting topic or model. How are you doing it?
Well, before we get into how I'm doing it, I'm curious as to what's motivating you to do it, and without revealing who it is, and so people can figure it out.
I can talk about it.
Let's get a little bit. No, let's not. Let's get into some specifics. What are we talking about?
Why am I doing it? What's my
the structure? How are you structuring it? What's your motivation?
That's a good question. So look, fundamentally, the reason why I closed my agency and I started the school was because I didn't see myself 20 years from now as an agency principal doing services. I worked for over 40 startups, and I'm like, wait a minute. These guys are building companies that are like, possibly
the future.
The future, right?
The future.
Why am I sitting here servicing them when I could be part of them? I couldn't make the jump into a committed relationship with a startup. It sounds like a marriage, having an agency and running an agency, because that's a whole animal. And the biggest issue is that I realized that the business model of the agency is in complete counter to the business model of the startup, and there is no way to provide value within that model to that. Meaning, I felt disingenuous and inauthentic in the services that I provided to the startups because I was marking it up double or triple markup. I was not staying on for the length of the business in order to help them reach that. And I wasn't managing the process, I had no control. I don't know. Management teams are really a big part of it.
Right.
And how the business gets executed if you have equity in it. And if you're a partner in it, you need to be a partner in it, like a for realcy.
So for you, and I think our take on this is a little different. You have a moral thing about not wanting to charge a certain price, but you want to be a part owner of the company.
I didn't want an exit to come from me selling an agency because those are horrible horrible exits usually.
Okay.
And by exit, when I mean exit, I mean you sold your company and you're getting cash for it.
But wait, hold on.
That's one.
I got to pin you down here. It's a 30-minute show, but
go.
I need to redirect you.
Go.
What's the structure of the deal? Are we talking about reduced fees, 50% reduction? What are we talking about? What kind of equity stake are you talking about?
The fee is cost, meaning that it's not marked up. So it's half of what you would pay. At cost of my time.
So if you book a person for $400 a day, let's say.
You pay
that's
$400.
That's $400. So there's no markup. Just
no
cover
markup.
your costs.
Yeah, but I get personal fees on top of it for myself for my time. So basically,
And how do you value that then?
I value it I'm valuing it based on almost like, you know, a day rate or a weekly rate.
A day rate that's comparable to somebody of your experience at your level doing that same work. Okay. So it's not a discounted rate.
It's not necessarily, no, they're not necessarily paying a discount now.
So you're basically trading the markup or the profit margin for equity.
Pretty much.
How much equity are we talking about? And what kind of equity?
Small amounts,
what's
a
small amount?
2 to 5%.
Okay. Is that common?
Yeah. I mean, for like a person of that involvement, you know, it's common. If you're like there every day and you are contributing to, then you go into the 10, 20, 30% kind of range. For partners, you know, in a startup, you're probably going to see a partnership of 50-50-50, let's say, between a developer, designer, and a business guy, and they all split it equally. Then investors come in, and that all gets diluted.
So you're talking about like 33.33%.
Right. That's if you use that model. There are people who carve out a portion of equity for other things like friends and family, etc., before dilution, which then you get into all these mechanics, which we don't want to talk about that too detailed. So does that make sense? I mean,
yeah, that makes sense.
2%, 3%.
So if do you define then a project, you deliver on that earns you your 2 to 5% equity?
No, it's a relationship.
I'm
in it to exit.
Really?
Yeah.
Oh,
I don't feel that my contribution will be worthy as a project.
So I'm very different than you then. Yeah. All right. And how long have you been doing this?
Right now, one of the first startups that I started with, it's been a year and a bit.
No, I mean, when did you first start doing this?
The alternative compensation. So when I had my agency, it was different. I'll give you one example and quickly. A friend in the industry asked us to help one of the startups they had invested in for equity only. I said, let's talk. I talked. We did a little bit of equity, but we said, no, we want to get paid. And we charged them half of what we would have charged them.
Okay.
That's it.
All right.
So it was instead of 50 grand, we charged them 25, and we took like 5%.
So I know since then you've closed the group. If you could go back in time and talk to a younger Jose, would you tell him to just take the cash, don't take the equity? These companies are not going to pan out. Or would you say, no, keep doing what you're doing? I would
tell him the opposite. I would say, take equity in every single startup you did. Don't do any startup without taking equity. Here's why. The conversation that goes into a bigger commitment. You're no longer doing it just for the cash and the fees. And that's why I said the business models they don't match very well. Because the interest of the startup is to keep low cost, high return, speed. So what I call velocity and fidelity. But an agency cannot provide fidelity or velocity in its model. It cannot. There's this person, the creative director, and the designer, this person, a producer. It's a mess.
But then if you stay in it till exit, that limits how many companies you can take an equity stake in.
That's correct. That is correct.
Because if we know anything
unless you
about
systemize it and you teach the community how to. So for an example, what I'm doing in Portland is I'm actually doing it right now on one startup. But for the next startup, I'm actually put a team together now. And the fees are higher to cover the team cost. Does that make sense?
Yeah.
So then you scale that to the next level. The next startup, you train the team locally in a system that works to allow it to deliver high fidelity and high velocity.
Okay.
I happen to know those systems because I developed them at the group, and now I can yield them or wield them for these startups. And that's why they hire me, by the way.
All right.
They don't hire me because I'm pretty or because I can design, because I can. I'm both of those things.
That's very surprising.
Yeah. But they hire me because I have the ability to execute strategy and execution, you know, project management on top of design. They can't get that anywhere else.
Okay.
They themselves say it, like, we want you because there's no other way to do that.
So unless you're Jose or you're in position to market your services like the way you have, a lot of our viewers are going to figure out they're not going to be able to make this connection, but that's okay.
Some of them do, actually. Yeah. I've met some of our viewers. Some
of our viewers are asking us how to design a logo.
So
at that level, it's very different. But we'll table that.
All right, let's talk about you now.
Because we're talking about, I don't know if we said in the intro, but this is the business of design.
We did
design a business. Yeah. Okay, I just wanted to say that. So, just talking about my own personal experiences, in the very early days of us running the company, we had people coming up to us and saying, let's do some kind of trade, because people want your services, they value what you do, but they don't always have the money to pay for it. And just the culture and the way that my father taught me, he was just like, you know, just work, live this kind of conservative thing. Don't gamble. Don't get involved in these high risk things. So almost patently, I just turned them all down. I said, if you can afford this, then this is great. Because what I didn't know then was my instincts were kind of questioning either the concept, the management, or the process, and those things kind of affect my ability to get the money back out. Because you were in it to exit. A lot of the dot-coms went bust, right? A lot of them. All these startups, there's a high failure rate.
Yep.
So you could be giving up a lot of time and potentially be losing out on that markup, that 50% amount of money you might have made in lieu of compensation that never materializes. So you've discounted the work for no exit.
Yeah.
So I have to really believe in the people foremost. The management team, as you've said before, the management team is very important to me. So recently, I'm seeing the last couple of years where I think I've built up enough of an infrastructure here. There's work coming in. People are making money. People can pay. I can pay my employees. They can buy a house or get an apartment or something. That kind of the basic needs are met. Now I can start to dabble. Now I can see like, okay, this is icing on the cake. And so I've entered into a couple of deals where I'm an equity partner in the company, and it's for a very defined scope of work. It's not in it forever. Now, that doesn't mean that if they call me and ask me a question.
By the way, I do have defined scope.
Okay.
I do have defined
But I define it as
contract times.
This is the amount that is going to be traded for money, cash, and this is the equity amount, and it's for this kind of work.
Got it.
But you call it evil, I believe. But I want very clear, defined boundaries, because I don't want it to be
beyond that.
3 years later, I'm still doing the work, and now what I'm getting paid is 25 cents an hour.
Right. I
don't want to do that.
I
Plus, I got to move on with my life.
Got it.
Right. So I evaluate that. So one of the things I look at is you have to look at risk versus reward. So the models I built are you pay all my hard costs, and even in that there's a little bit of markup, but it's all discounted rates. Okay. So I'm going to cover my costs because there's things like machines, software, a support team, or the people on your staff that are impacted but aren't billable. The receptionist, people getting lunches for people. It's that kind of stuff. So that I'm not purely, if a person is earning, say, $400 a day as a day rate for me, it's going to be marked up a little bit. Let's say $450. Because what people don't understand, there's insurance, there's a lot of other things packaged in that, because you will lose money.
Yeah, I mean, the cost of sale really does include a lot of the infrastructure and the overhead.
It does. So now I'm looking at what's the exit scenario, what's their business plan.
Yeah.
So are they in it because they want to build the world's greatest community? That doesn't sound like a great exit plan.
Right.
It might be a great thing to do.
It might have been
on
Facebook,
a human level.
though. Yeah.
It might have been Facebook.
Yeah.
I don't know.
Yeah.
But I'm pretty sure they had a pretty smart business plan.
Yeah.
Right? People could see that. So the guys that I'm working with, they're very straightforward. We're a build to sell model. Right? And that means that they have no delusions about building this to be the greatest company ever
So
seen.
they're doing discrete things like a game that they want to sell to a larger company. Yeah.
Basically, what they want to do is to disrupt or annoy the market leader in that space enough so that they just want to kill their competition.
That's interesting.
And they just sell it.
It's a very quantitative approach, which
It is.
matches with you and your
It does.
kind of risk profile, which I like.
And I see that. So they say, maybe in 2 years, 24 months, we can sell this company for $20 million, which isn't a lot of money in that kind of space, right? It's
not. If you have 10%
$20 million.
of that, that's $2 million.
And let's say if I have 10% of that in $2 million, so in 2 years, I can get this really great payoff. And if it doesn't work, it doesn't work out. But I knew the risk going in.
Yeah.
Now I want to contrast that with another case that somebody brought to me, another game, and we talked about it a little bit, and they valued their company at $50 million. I have no idea where they got the number from.
50 million?
50 million, because they think their idea is worth that.
At this point, you mean they valued it at
Yeah,
that price.
and basically they had a little bit of money from friends and family, angel investors, and they just arbitrarily pulled out a number. I have no idea where they got that number from.
That's an odd valuation at that early
So
stage.
then what they said is, well, 1% of 50 million, my math isn't good. Andrew, what's that? Where's all my Asians?
Right.
5 million?
There's all these Asians in here.
We're going to trade you $5 million of fake value for all your services.
Well, the valuation was too high. That was the issue.
It was way too high. But
too
plus, I also saw like, if you want to give me 1% of your company, I can see how you view the relationship. So it's not one that I could move forward with, right?
Totally.
It's not what I want.
That
I
was
don't know why.
hyperbole.
Well, they don't believe so.
Yeah, but okay,
They don't believe
that's
so.
fine. So
Everybody, you guys watch enough reality TV and Shark Tank, everybody thinks their company's worth so much money.
But no, let's be realistic. Look at how investors look at it. And then for our audience, and then if you guys looking at how does valuation, what is valuation? Valuation is simply what the company will be worth at an X time, let's say a year from now, relative to the possibility of actually building the revenue and then a multiple of that. For an example, if me and you start a business and we say that making these bottles, and we say that within a year we can be selling $100,000 worth of these bottles every month, that is a $1.2 million business. 12 months, it's $1,200,000. So that basically puts our valuation, if you multiply that, let's say times 3, maybe.
For this kind of market, it's 3 would be generous, wouldn't it?
Right, that would be generous. So let's say, okay, let's say $3 million is the valuation for your smart bottle company.
Right.
In a year, right? And so that's more realistic and that's better to do, but this guy's $50 million.
Well, hold on. What is that realistic based on? I've not sold a single bottle.
Your track record, your background.
But I've never made anything.
Okay,
so
then I have a problem.
So you see what I'm saying?
I have a problem
There's problems.
So keep in mind that that's all about narrative. So there's all these different narratives that play a role in what they're telling you. So the scenario that our audience is going to get is a very hyperbole-ridden person saying, "Oh my God, this is the best thing since sliced bread. Help me out. Do the logo and the identity for free, and I'll give you equity." That's what they're going to get out there. So don't do those. Don't pay attention to those even. Just say, look, here's my fees. Cut the fee a little bit, and then take a little bit of equity. But community is important too. You're getting deals from your own community. I'm getting deals from my own community.
Right. Before we talk about that,
okay.
I want to make sure we complete the
valuation talk.
Yeah. Well, before valuation, also on equity. So a lot of people say, well, this is worth this because I got a little bit amount of money. Or let's say I can go along with this. If you got $1 million and you gave away 10% equity, so 10 times $1 million, I would say your company's worth $10 million because somebody invested that much and that's what you've sold it for.
If that's the case,
that's fine.
Yeah.
If you have, say, no real revenue, but you're growing users by 400% every month over month, somebody can say that's worth a certain amount of value. But you got to track it against something. I can't just be like, you know what? This is worth $50 million, or this is worth It's not even worth $5 to me right now.
Right.
Because right now what you have is negative revenue, you don't have a track record, and the management team doesn't have a clear exit strategy. There's no way I'm going to get involved in that.
You just made me think of that we should have Shark Tank for designers. That would be awesome. Like have designers come pitch ideas. All right.
Okay.
That was a joke, but
all right.
What do you guys think? Tell us in the comments if that would be a good idea.
Right.
All right.
Okay.
So let's go back to the next topic. So
that we took care of valuation. We talked about some stories about how you've done it, how I've done it, and we'll see how this all works out.
I mean, ultimately, the question to answer for the kids is like, how do I do it? How do I discern the right deals? You guys are old, experienced people, and you've done it many times. The reality is that you're going to have to dip your toes in somewhere, and you're going to have to learn by making a lot of mistakes. And that's what I did. I made a lot of mistakes. You know me well enough today that one of my big, pluses is that I go out there and I try it. I'm like Mikey. So I've tried it every which way to Sunday, and most of it fails. But it sets up the foundation for what I'm doing today. Without having done, the 30, 40 startups that I did while I had the group, I would have never been able to do what I'm doing today.
I want to talk about one more subject that's related to this, I think. Sometimes you're on the other side of the fence. Let's say you have a product, a company, a service of some sorts, and you want to bring in somebody that potentially provides tremendous value to you.
Yes.
And what you're thinking is, I'm worth X and you don't really do anything.
Interesting.
Because you're in the idea space and I'm in the doing space. So let's talk about that. I have an experience where it's been, I think somebody that's watching this will know who they're talking about, who I'm talking about right now.
So you're talking about somebody who's watching this.
I have a buddy, and he had a product, a consumer electronics product, and he and his friend partner decided to do this thing, and so they're 50-50 partners. That's how it worked out.
Worst idea ever, by the way. Designers love 50-50. I hate it.
Well, whatever. However they want to do, that's fine. And so they got to this point in which they realized they're not going to grow the company anymore. It kind of stalled out. And I had been kind of coaching them along the way, just as friends do. But at some point they said, we want to invite you into the company and we're going to give you an equity stake in this thing.
You?
Me.
Okay.
And I said, for that, I will help you.
Okay.
And no money needs to exchange hands. I'll figure out your strategy. Platform. I'll even build.
So you're an advisor. You're getting equity as advisors.
I'll even build your site out for you, and I'll help you figure this thing out.
That's awesome.
I can't promise you it's going to do X, Y, and Z, but we got stuck. You know where we got stuck?
Where did you get stuck?
The valuation.
What they wanted.
Well, what kind of equity they wanted to give me in exchange for that?
Oh, an advisory equity is usually traditionally between 2 and 5% also.
Is it?
But if you wanted like a third of it, or you wanted too much,
I think I want too much. I want too much.
You're too aggressive.
Because I may be too aggressive, but I value what I do.
So
I really do. I got to tell you. So my starting gambit in that whole thing was, look, I don't want to take your company away from you, but 10% to help you grow this company and to build out your site. I'm spending money.
Right.
I'm going to spend money in this thing, and right now it doesn't even look like you have positive revenue. But they couldn't get over the idea. They just
giving
couldn't.
You more equity.
Of
How
even
much were you
10%.
asking for?
10%. That's all I asked for.
That's okay.
It's all right. I wasn't too greedy.
10% wasn't too
10%.
greedy. Yeah.
I could have easily said, I'll take 30%, and we'll be three-way partners in this.
It's better to have
I'm putting
a
real
small
money
percentage of something that's going to make it big than zero of something that doesn't
right.
happen.
And if you guys watch Shark Tank, they make this mistake every single time, because you got 100% of nothing. Nothing. And you can see it time and time again, the right management, the exposure, the experience, and the leadership that somebody can bring to the table, right, can bring your nothing company to a $10 million company, even though you might only own half. But half of 10 million is much better than 100% of nothing.
100%.
People need to understand
Let's
that.
talk about it from a spiritual level.
Wait, before we do that, don't flip the narrative just yet.
Okay, got it.
Okay, so long story short, there was a little friction in this discussion. I said, you know what, you guys, if you don't feel it, I don't want to sell it. That's totally cool. God bless you. Move on your way. And you know what? A year and a half later, that thing just fizzled. They had 100% of nothing. If nothing else, I would have built them a better website with better messaging. If nothing else, I'm not saying I could have made a difference.
Here's the thing: those percentages do not matter. You know when they matter? They matter when the company actually starts making money. That's when everybody starts going like, ah!
But I'm in it to make money.
Right, you are, and that's a great partner to have. I mean, that's obviously
this is the business of design.
At the table, right? The business of design. What I'm trying to say to those people, not just those people, but to our audience is, at this point, when you're trying these things out, assume that they're going to fail. So don't worry about the percentages. 30, 40, 50, 50, whatever. It's good. If it succeeds, you could even renegotiate that at some point and kind of like, take stuff back and sell back equity. But the point is this: if you get hung up on the percentage, that wasn't even valuation. That was the percentage.
It's percentage.
If you get hung up on that early on, just keep in mind that it's whatever. If you get hung up early on and you make the mistake that they obviously made, that's the mistake. You actually might have. It's better to give away a little bit more of something that works than not. That's my point. I'm always very generous with how I carve things out, if I know it's going to work and it's the right relationship. And that's where I go to the spiritual sense.
Let's do it. Bring me to church.
Well, but the spiritual sense is that you're doing it very quantitatively, and I'm doing it very much about building a relationship in a community. So
Hippy-dippy?
Kind of hippy-dippy, yeah.
Okay.
I've been spending too much time in Portland. No, actually, that's not even Portland. That's more like Austin or San Francisco.
That's just more like your apartment.
That's Saturday nights. Yeah.
Right.
So, but what I've learned is that in the investment and in the growing businesses and companies in the startup community, in the tech community, it's a very close knit group of people, and it's usually the people that you're traveling with the longest. So trust gets built over time and over execution. People seeing you execute. I'll give you an example. So I know I needed to raise money eventually for the school. And I started meeting with some of my people in my network just to listen to what they were doing. The former creative director of the group, who's an old friend from Razorfish, Henry Min, who's also Asian.
I figured that out with the Min.
Thank you. He actually was doing product. He started doing startups when he was at the group. He got all into the bug of entrepreneurship. He was doing his own thing. A group of investors asked him to help with one of their startups. And he did for a year. He helped do product development, and they're like, wow, you're really good. What are you doing next? Oh, I want to do my own startup. Oh, here's $1 million. So he got an investor not by going out and pitching and asking. He got it by being of service and of value with what he was good at. He's a designer. He does product development. So I'm doing the same thing. From him, I learned that, and I said, you know what? Faithfully deliver value to the community that you're already working with. Other people will come, and then you'll begin getting. So what I'm doing is a precursor. It's a practice. I'm 40 right now. Remember my goal I said at the beginning. I don't want to be a 60-year-old dude running a studio, like still dealing with clients. At that point, I want to be done, have multiple exits, advising, investing. That's what I want to be doing, right? Be an old man, which I am now probably. But the way I'm doing it is by building the community and slowly beginning to train, coach, and have multiple startups that I have. It's like portfolio theory, basically. I know I need to have a small amount of equity and at least 10 startups, whether they're here in LA, whether they're in Portland, it doesn't matter. because I know that one of them will hit big. So whatever the percentage is, I might make it bigger over time because my contribution is proven. When the first startup that I'm advising exits, which it will, and people are like, well, you're so very confident. I know it will. And how do I know it will? Because I've done it a million times, and I've seen the team, and I've seen the process that we're doing, and I'm confident in that. And when it exits, then people are going to say, damn, dude, how did you do that? We want some of that. And then my equity ratio goes higher. So what I'm going towards is that eventually the designer, let's call it design firm, let's call it, we're no longer a service provider, we are now a value provider, and we're getting paid on the upside. So we're like VCs. I want us to be like VCs, like where we provide the value of our advice and of our design experience.
Well, VCs have money.
We have
Venture capitalists.
We'll have that too at some point soon.
At some point, okay.
Yeah.
Just
so we can
sure.
After we prove it a few times, we can go raise, 10, 15, 20 million and start investing in our own companies that we are advising through the cycle.
It's a good plan. Let's see
right.
how it plays out.
That's it.
I do want to challenge you a little bit on a couple of things, or at least
it all sounds crazy. I know
it does sound crazy, and from a guy who's, thank you, Nicole, from a guy who's been taught, there's no get rich quick scheme. It's just hard work and perseverance. I'm the tortoise on this one, and you're the hare,
yeah.
And I've been just slowly building it, and I've built up something where I think I'm getting close to that place where I'm close to hitting my goals.
Yeah.
Where work is going to become a thing where it's not a necessity, it's a luxury.
Yeah.
Where I don't need to.
Right.
And so I've been building out that plan. So we have two very kind of different platforms, and that's why I love this dialogue.
Yeah.
You have one way of solving, I have a different way.
But we're all going towards the same goal.
We are going towards the same goal,
Yeah.
just different ways of getting there.
Different ways of doing it.
And only time will tell what way works. We don't know, right? So, but I do know this. I can only do as an artist, as a designer, not as an artist. I'm going to take that back.
As an artisan,
designer,
as a crafter.
as a crafter of things, right? I can only do a few things well. And so that's where I get really concerned, where I don't want to spread myself too thin. I know how I work. I'm going to go deep,
Yeah.
and I'm going to dive deep on your project. I'm going to give you tremendous value for that and give myself to you, and that's worth a lot to me.
Yeah.
And so that's where I don't know if I can do that, where I'm trying
I'm going wide.
You're going really wide.
But I'm also, and then what I'm providing is the systems in which to do it so that I don't have to be in it. I'm training other people to do it, which is, by the way, it's good that our partnership, our relationship really works in that context.
Right.
Because we can do projects where you're pushing for deep and I'm pushing for wide. And that moves us a little bit faster. So it's basically, instead of the tortoise and the hare racing separately, we're kind of racing like with each other, and one has to catch up, and then you slow down and you catch up.
Right. Right. Okay.
It's a better pace.
Well, what I love about our dialogue is that you have a very different way of doing it. I have a different way of doing it, and there's probably 10 other ways to do it.
Neither is wrong.
Who knows? Whatever works for you, and this is why I think this is great. Some people are going to connect directly to what you're saying and say, I can relate to that. I understand
and
that
it's personality based.
Sure.
There's people, you are evil, dorky, and I am flaky, obnoxious. So our personalities, we're executing the same goal in different strategies. Let me give you one quick insight.
And I just want to give you a reminder, we have 2 minutes left here, so we do need to wrap up this episode.
I'll make it this simple. So from a model of artists that are taking control of their careers, I saw a great interview at South by Southwest with Nick Cannon. He's an actor. No, he's a writer, producer. He does like a million things, like super ADD. And he talked about his ADD. It was really funny.
This is Mariah Carey's husband?
Yes, I think he's married to Mariah Carey. But I liked what he said of how he sets up all these different things happening at the same time, and some start here, some start there. They start at different times. He has a team around him that helps him do those things because that's who he is and what he wants to do. He wants a million things happening.
Right.
There are people who just want to focus. Now, that's a creative that's doing it in a specific way, but he gets ownership in a lot of his products. And the partnerships with the studios and stuff, he got a cut of the upside.
But here's what I think about that. And so I don't want to send the wrong message to some of our viewers out there. Is he did something really well and he made a name for himself.
Early on.
And then he built up a team of people he trusted. And then he could start to do these things, and then he delegates that, and that's what's working for him. So he has his, his core competency and what people pay him lots of money for.
T-shaped creative.
T-shape, right? So a lot of people make this mistake, and they say, I'll do this, and then they never really get good at anything, and they're betting the farm on everything, and nothing pans out, and then they're broke. And you've heard me say this before, and I think designers, we get into this. Designers, and I'm a designer. I used to care about all these little things like kerning and letting and all that kind
We're
of stuff.
talking about our Facebook conversations.
Yeah, a little bit,
like,
a little bit. And we can get lost in the details, and that's what the world loves us for, and that's what we high-five each other for. But outside in the real world, in the business context, nobody cares.
It really hampers us. And I see it happening in our organizations and in our professional organizations, and it frustrates me, and I'm kind of brash and obnoxious, and I offend people really well. So if you guys are out there watching, yes, I offend people all the time because we're pushing a different agenda, and we're pushing, for us as designers to have more power and to have more equity in what we do. There are people doing it.
Well, I just look at it like designers as entrepreneurs and not as service providers.
Yes.
That's a big deal.
Designer's entrepreneur, that's a great topic. The designer as entrepreneur. Look, Yves Bayer is doing it with his studio. People like, Jay-Z. I'm not a businessman.
Philippe Stark.
I am the business. Philippe Stark. So there's a lot of singing going on. There's a lot of models as precedents for us as entrepreneurs. And I know that a lot of people out there watching, and that you're watching this, or that you've been following what we've been doing, what I've been doing, and what I'm doing with Chris now. And you're not looking at it only from the point of view of, hey, I want to service my clients better. You're looking at it from the point of view as, like, hey, what do I do that I can do that isn't client services? A lot of people won't admit it, but that's
the Holy Grail.
Yes,
isn't it the Holy Grail? But we get stuck on doing this kind of stuff.
That's all we know how to do. That's the 20th century model. So what are we going to talk about next week? And you know what I want to talk about. Maybe we don't talk about that. We talk about designer as entrepreneur.
It's up to you. Well, you have to tune in next week to find out.
We're gonna flow with the Holy Spirit. So let's do that. Thank you guys for watching and spending another half hour with us. Don't forget to subscribe and don't forget to tweet and to leave comments below. Tell us what you want to hear about. Is this valuable to you and to the community? Let us know. Chris, we can continue talking about other stuff here.
All right, thanks to everybody in the studio audience. Yay! All right.
So
hippy dippy?
Kind of hippy dippy, yeah.
Okay.
I've been spending too much time in Portland. No, actually, that's not even Portland. That's more like Austin or San Francisco.
That's just more like your apartment.
That's Saturday nights, yeah.
Right.